Wall Street gets a blank check, but Main Street can't borrow a dime. Public employees get a free pass while the private sector picks up their tab. Who's fighting for business, and how do we turn things around? Welcome back to the second hour of Brian Bushlach's Business Briefing on FM News 101.
And we're back at 5:07 for the second hour of Business Briefing. Want to thank our guest in hour number one, Suzanne Stevens from the Portland Business Journal. Business definitely on the rise in the Portland metro area. Thanks to her for her insight and our partners at the Portland Business Journal, including Wendy Culverwell. Great insight, that real estate email we get every day. I count on that for my real estate information, so good stuff there. I mentioned off the top of the show we had our huge event, CRE Kickoff 13 at the Bing Lounge on Wednesday morning this past week. It was a sellout event. If you missed it, you missed a great opportunity to hear Michael Lortz, a CPA and lead AP from Geffen. So we brought him in studio this weekend to talk about the big tax changes and the update here. Michael, they went down to the wire. We actually went over the cliff. I told Patrick Stone it feels like that Wile E. Coyote cartoon where we go over the cliff and we're hanging now from that branch waiting for, the next shoe to drop here in Congress. Very interesting times out there. We had a lot of changes. What do you think was the biggest thing we saw come out of Congress with these tax changes?
Yeah, thank you for inviting me, and that's a good question. For folks that are operating small businesses, for folks that are real estate investors, there was really a mixed bag. A lot of folks certainly have highlighted the negatives in terms of some higher tax rates, ordinary income rates, capital gain rates. But there's also been some positive things in terms of depreciation write-offs and expenses for those folks. And then for most folks, if they don't own a business or own real estate, they're probably pretty focused in on the payroll tax cut going away, Social Security taxes going up a bit. Those are the things that jump out at me right off the bat.
It's interesting because capital gains got quite a bit of the spotlight. And in your presentation, I thought it was interesting because not only is there a jump in capital gains for certain folks out there, but there's also the Obamacare surcharge or the tax that hits on top of that as well, right?
Yeah, absolutely. And there's really a couple different surcharges that were part of that act. But the big one is on net investment income. It's a 3.8% rate. And it applies to a whole lot of things. Certainly it applies to most capital gains. It applies to interest income, dividend income, income that you might receive where you're a passive investor and just receiving a check. So it really applies to a lot of things, and it will make it tougher to get deals done when you're putting those pro formas together.
That's interesting. Let's talk about the impact of this. You had some great information. Maybe run us through kind of the highlights of this legislation as you broke it down for us during Wednesday's event. It was a great recap for everybody there. We had over 75 commercial real estate brokers, CPAs, attorneys, and folks in commercial real estate. And we got great feedback on the event, so I want to try and bring that back for our listeners here.
Sure. The first thing, and this may seem a little bit mundane, but it's certainly been on a lot of people's minds. One of the impacts of this late change is that people can't file their tax returns as soon as they would like to. And that affects some people more than others. Certainly if you're out trying to get a loan and have to show a tax return for 2012, that can present a challenge, and it has presented some challenges for some folks already. IRS just released guidance letting people know that many folks will be able to file returns beginning January 30th. However, if you're a business owner, a real estate investor, you probably won't be able to file your return until significantly after that date. Could be sometime in February, don't know exactly when, that forms will be available that are needed for those folks to file their returns.
It's interesting because I think there's a misconception among the general public that CPAs are busy between February and April 15th, and that's not the case. You're extremely busy year-round with so many deadlines, not only for personal taxes, but corporate filings, year-end planning. It seems like there's really the busy season is 12 months of the year now.
Yeah, that is one of those interesting things, and there's been some changes over time that have contributed to that, but while we still do call January through April busy season, we still have plenty to do the rest of the year, particularly for folks that are interested in planning and that's really what we specialize in.
Michael Lortz, a shareholder at Geffen Mesher, in studio with us here to talk about the impact of the fiscal cliff tax legislation. And one of the big things they did actually fix here was AMT. Why don't you tell us about that?
Sure, and I'll try not to put your audience entirely to sleep. Typically, alternative minimum tax, or AMT, causes half of my audience to just kind of glaze over. But, it's something that I think is sort of an unknown terror that you hear about. People talk about, oh no, I'm in AMT. And an AMT is basically a structure that causes people to pay more tax if they fall into it. Basically, the government says, we'll give you a bit of a lower tax rate, but we'll take away some of your deductions. So a good thing and a bad thing. And ultimately, if that alternative calculation results in more tax, congratulations, you get to pay that difference. And that's really what AMT is. And originally, it was targeted toward folks that were, toward the top percentile in our society. But gradually, over time, it's really come to target the middle class. Folks that are upper class, quite frankly, most of them make more money and aren't required to pay AMT. So one of the changes they made was they increased an exemption amount, which helps people not fall into AMT. Plenty of folks still will, but just less than would otherwise. They also indexed that exemption amount so that it will keep going up over time. So hopefully that will continue to protect folks that are middle class from falling into AMT as much as they would have otherwise.
Yeah, this could have impacted quite a few people, right?
Absolutely. I mean, I think I've heard numbers, in the 20 million range in terms of the number of taxpayers that it would have impacted otherwise.
Now, the payroll tax holiday goes away. That impacts, I think, I saw a statistic that showed 77% of Americans now will see less money in their paycheck because of that. Obviously, that was something that I guess they probably had to roll back after the last few years.
Yeah, it's existed for 2 years, 2011 and 2012, and I think the original idea was to try to stimulate the economy by giving people a little bit more money in their paychecks, and presumably they would go out and spend that. So that rate was dropped from 6.2 to 4.2% for 2 years. It's back to 6.2%, and so ultimately that does mean that most Americans will be paying at least a little bit more in taxes.
Michael Lortz, Geffen Mesher, in studio to talk about the impact of the fiscal cliff tax legislation. He was a speaker at our event kickoff on, last Wednesday at the Bing Lounge here. Hard to believe it was that long ago. It seems like this week flew by, but Michael Lortz joining us in studio. And, it's interesting when you talk about year-end 2012 with the beginning of 2013, paint the picture for us. What was it like? Because a lot of clients doing year-end tax planning, estate planning was very big at the end of the year, and it's actually been very big here to start 2013 now that we have something solidified moving forward.
Yeah, absolutely. I might start by talking about the estate planning that you mentioned, because we absolutely saw a lot of clients updating estate planning documents, making significant gifts to future generations, their children or grandchildren. And they were doing that because they thought, or we thought, that it was very likely that the estate tax exemption would decline after 2012. Lo and behold, it did not decline. It's still $5 million a person. The tax rate increased a bit. But what that means is that there was a lot of activity the last quarter of the year. A number of the estate planning attorneys I know told me, we're completely booked and we can't take on any more clients before the end of the year. Don't even have time for lunch. We're working through lunch every day. So that was certainly very busy. And then on the income tax side, there were a number of things that were changed retroactively. A good example is a depreciation deduction called Section 179 that was increased retroactively for 2012 that allows businesses to write off more of their purchases.
Well, it's been an interesting period of time, and we only have 60 seconds before the break. When we come back, we'll talk more specifically about commercial real estate. And for you business owners out there, that's the prime target of our audience here. We'll talk more specifically about the impact for you. But were you surprised they kept the estate tax where it's at? I thought they would scale that back a little bit.
I was a little bit surprised, although more recently I had been hearing that was likely. A lot of the East Coast politicians have folks that have a lot of wealth, and that $5 million exemption is important to them.
It is, and that's the way it stays, a little over $5 million. A lot of folks have used that up now with the year-end planning. It'll be interesting to see where things go moving forward now that that's indexed to inflation. Michael Lortz, CPA, lead AP at Geffen Mesher, joining us in studio. If you'd like to contact him, if you have questions specifically about your scenario, his phone number 503-445-3368 or head to gmco.com. More with Michael Lortz.